Good Thursday, everyone. Welcome to our Long Verticals and Diagonals webcast. I'm Connie Hill. Happy that you would join me here today as we study these two strategies, which can be kind of some bread and butter strategies for you. Now, I want to see how good you are here. This is a little bit smaller than I wanted to show. Can you tell what I'm holding in my hand here? It's not the biggest version I have of this, but this is a tube of toothpaste. Can you tell how much has gone out of the toothpaste? Almost all of it, but not every little last bit. Okay, what does this have in common with how we trade or can trade verticals? That's what we're going to explore today. And I want you to be thinking about my little tube of toothpaste here as we discuss it. Now, I am joined in the chat by Scott Thompson. Glad Scott's here. You guys know him, great veteran of the market, and teaches one of our classes. He's also one of our managers here. He's here to help me with any questions I might not be able to get to, but we do want your questions, so chat them in. I'll keep my eye on the chat as Scott will as well. Now, if you're on the recording listening to this and you have questions, you put your question in the comments section in YouTube because we go back and review those throughout the day. Make sure you can get your questions answered as well. Well, hope you're following us on X. I'm Connie Hill, CS. Scott is Scott Thompson, CS, and we'll post educational content. Things we're noticing about the market, we will post them out there. So follow us. It's free. It's easy to do. Let's go through our disclosures and get into our agenda. We have a lot of ground to cover here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today should be for educational and informational purposes only. Don't consider it a recommendation. We'll be using the Paper Money software application. It's a great educational tool, and I suggest you use it to practice strategies and develop your rules. Investing involves risk, including the loss of principal. One thing that's different in Paper Money is that it will not assign short options early. That's something that can happen in a live market that Paper Money does not emulate. If we get in a situation like that, I like to bring it to your attention. All right. Today, we'll have just a quick announcement. We'll talk about long verticals and diagonals. We've got a lot of follow-up to do. We're going to be looking at several examples here today, as well as I've got 3 trades I wouldn't mind putting on if we have the opportunity to get to all 3 of them. All right, the announcement, upcoming workshops and market drive events. Hopefully, if you're in Southern California, you're heading out to San Diego tomorrow. Right now, we have Barb and Kevin and Ben on their way to San Diego for that workshop that starts tomorrow. A couple weeks later, we'll be in Chicago. A couple weeks after that, we'll be in Dallas for a market drive event. So if you're close to any one of these major populaces or it's easy for you to get there, it'll be worth your time to do so. Okay, so I'm going to encourage you to do that. Well, let's do this. Let's head over to my Thinkorswim platform. Take a quick peek out if the markets are recovering here now. Oh, would you look at that? The SPX has gone positive here. Let's see about the NASDAQ. It was in deeper doo-doo earlier today. So NASDAQ definitely gapped down. It's still down about 8.85%, but looks like maybe it's trying to bounce off that 10-period exponential moving average. We'll see what happens here as the day goes on. Let's get the Russell 2000 here. Now it is in a nice positive position, up over 1%. And if we look at the Dow Jones, let's do $DJI here. We can see it's up 1.5%. So the Dow having a strong day, putting in another new all-time high. From yesterday's price action and early today, it looked like maybe the market's having a little bit of pause, but looks like a lot of the market is getting back into, and it could be just a couple of stocks really driving down the NASDAQ right now. If the indexes are continuing to progress, what do you suppose the VIX is doing? Suppose the VIX is high? Do you suppose it's low? Yeah, we're going to suppose it's in a lower area, probably isn't inching up today. It looks like it is down a little bit. Earlier today was at 16, now it's at 1573, so just a little bit under that. Down here in a calmer area, not as low as, say, 12, which it had been a lot of last year, but certainly down in a lower area where there's not a lot of put buying action that would give us the idea that maybe markets are skittish, right? Not really seeing that right now. Now, first thing I want to do is I want to put on a new trade, and then I want to take us through some of our trades that are ongoing, as well as some trades that finished up, and talk about those. And then I'd like to put on a couple of other positions after that. But there's one I absolutely want to do first. All right. And it comes from our liquid options watch list that we're using as a class. Happens to be this first stock on the list, UNH, United Healthcare. I guess they think the flu season was pretty easy, and they're expecting some good things. So they're having a nice little pop today. You can see, so we zoom in here a little closer. It was down here on our 30-period moving average. It's kind of a gentle pullback, nothing too extreme. And then getting a nice little pop today. Some of you might look at that as a hold, close above the high of the low day, or simply just take in a nice bounce off the moving averages. Okay, some traders like to look for entries there. So for this very first trade, it's moving along well. I'm looking at doing a long call vertical here. We've done pretty well. You'll see in a minute with some of our long call verticals. And the idea here would be if things are just churning higher and higher, let's take advantage of that. Stocks that are upward trending that we think are moving well, yeah, let's do a long vertical on those, see what we can get out of them, if anything. But so far, they've been treating us pretty good. On this one, let's see if these numbers still make sense. I don't know if they still will. We're going to use the June 26 options expiration date. We've got lots of open interest. You can look at the calls and the puts. You're like, yeah, there's some people out there trading these contracts. And so it makes it a little bit more comfortable going into that. It's trading in $5 increments here. And many times for verticals, whether they're long, whether they're short, many people like to use a window of, say, 20 to 40 days worth of time. Now, this is at the kind of the lower end of that range, but it's got 22 days left here. Now, initially, I was thinking here we might do a 400, 405, and I think that's still going to work pretty good because 400 is going to be our at the money strike price here. Now, if we do a 400, 405, we'll come in here, we'll say buy vertical. It's going to cost us about 240. So our max theoretical loss here, and I'm going to lock that up, would be $240 for the opportunity to gain what? $2.60. So risking 240 to make 260. You do the math on that, it's a little bit more than 100% potential return. Okay, although we may not necessarily treat it that way. Let's see what we need the stock to do. Let's go back to the chart here. We would want it to be above 405. Well, how far away is 405? I'm going to put my mouse there. Oop, that's 406. Got to get a little closer. Oh, there's 405 and some change. Is that a big move we need the stock to make? Not really. Okay. However, we're going to do a fairly conservative trade. We're going to say we don't expect a ton or don't need a ton of movement for that shorter period of time. Okay. So as we come over here, we're going to use our calculator and clear this out. In this class, we've allowed ourselves to risk $2,000 per trade. So let's do the math. Let's see how many contracts we can do here. If we've got 2,000 per trade, we're risking 240 per contracts we get in. We could do 8 contracts here. So we're going to, okay? We are going to do, and let's maybe move this out of the way for just a moment. Let's go up here and do our 8 contracts. Now, I told you we're risking 240 to make 260. Are we really going to try to get 260 out of this spread? That is the theoretical max. But going back to my little toothpaste here, we want to maybe get a bunch of it, just like we have on the toothpaste, but we are not going to try to milk out every cent. Okay, that's been our approach. And I've asked you in our classes, what percentage do you feel comfortable taking some profits at? Is it 50%? Is it 60? Is it 70? Many times you'll chat that into me, and you're welcome to do it right now as well. Because I'm always interested in that. And sometimes I pick your numbers. I think we had a 73.2% that we did last week that was somebody's percentage that they liked to do. Let's see here from cousin Cahill. I'm going to call him my cousin. I don't know if we're really cousins. In Texas, we just have the same last name, right? If you wanted to scale up trades like this to seek higher returns, would you look for a larger strike price spread, or do you go higher number of contracts? How do you compare these two choices? Well, we'll do that. We could do that here, Kevin, or not. You're my name, not be Kevin, cousin. You're Kay. Let's look at what would happen here. Okay, let's do something here real quick. If we have 260 as a potential return divided by 240, that's going to give us about 108% theoretical return. Let's minimize that right now. Let's come down here. Let's just write that in, 108%. Now, if we wanted to be more aggressive and say, man, I really think this stock has got a lot to move, you're not even asking it to do too much, Connie. You're looking at 205, and maybe you're somebody that says, I think it could get up to 220. Okay, then you might choose to spread it out wider, have a higher target. Of course, the probability of success is going to be lower because you're expecting a lot more out of the stock. Let's unlock that here. For a 10, actually, this would be what, a $20 wide spread. Let's bring back our calculator and do some math here. So if we have 20 minus 660, that means we'd be risking 660 to make 1340. Well, if we divide 1340 by 660, what's that percent going to be? That's looking for over a 200% return. So it depends on how aggressively you want to structure it. We're just doing a fairly safe structure now, not asking the stock to do a lot. But if you thought, yeah, stock can really take off, I want to go for more, you certainly could spread that out. And you'd have to go through and do the math for the exact strike prices that you want, right? And see if it makes sense to you mathematically to try to maybe have more potentially to receive on the trade than what you're putting out on the trade. So it's up to you. Experiment with it. That's a great thing you can do in paper money, is you can throw in both of them in your paper money account and test them out and see how they work. Key with that is making sure to maybe not overlap with strike prices, where you've got one that's positive and one that you're selling. Now, in our case here, let's minimize that. We're going to take the lots of toothpaste out of the tube approach. Now, you guys are saying take 50%, and we've got a lot of 50%ers. Look at this. Jenny says 30 to 50%. Jenny is interested in maybe not requiring a lot of the stock and being content with maybe half the tube of toothpaste. Maybe it happens in a couple days. Who knows, right? And of course, it's not guaranteed to do that just because the market's going up and just because it's upward trending. But we know we put those things in our favor if that's what we're looking for. Now we're going to go back to our original here of 405. We're looking at 220. Ooh, it was at 220. I'm going to put it back down there. Okay. And I'm going to go with your 50% on this. Okay. We're going to go with the majority rule in this class. Sometimes I'm democratic that way. Let's do a first trigger sequential, and let's put in that opposite order to say, if we get this amount, let's be happy campers and be on our way. So 220 is what we'd be risking now to make 280. So, okay, let's go with 50% of 280. That's going to give us $1.40. We're going to add that to the 220 and say, all right, if we get premium gets up there to 360, we'll be happy, we'll get out. Now, your percentage that you might want to use is a little bit, you don't have to use this, you could use whatever you wanted. I think that was 360. Let me double check here. Yeah, 360. And would want to make it as a good till cancel. Now, question's going to come up, should we do a stop loss in here? You could if you wanted to. Some people might say, well, I'll take 50% of the price of the spread. If it gets down to 50%, maybe the trade's not working out so well. Maybe cut losses a little early, move on to something else. Okay. Typically, we don't structure it that way in this class, but we could. And as a trade progresses, sometimes we'll go in there, we'll maybe adjust this order to say, yeah, keep it at 360, but let's add in a stop loss and put it as an OCO order. Right now, we're just going to put in if we are on the right side of the trade. We're going to put this in our dynamic diagonals and long call verticals bucket. All right. I don't know if Cahill and I are really cousins. I do have some cousins who have the first initial of K. I've got a Katie. Who else is a K? Doesn't matter. Okay, I don't think we're really related. There's a lot of Hills in this world. Mary Burns says, any thoughts on the fact that the volume is pretty high on the move, so we're not seeing institutional support? It also seems to be hitting a ceiling at the 408 mark. So this, I'm gonna zoom out here a little bit. This was kind of a previous peak for the 52 weeks, right? So we're seeing that 404 high. But, you know, if we were to go back in time, are we really seeing a lot of history there? Let's go back to say like let's go 5 years. Yeah, it certainly has been higher. But let's see here. Let's maybe kind of come in this way. We're looking at it here to maybe go beyond this little peak a little bit, whereas maybe the next resistance level isn't up till, oops, that's the wrong tool, but maybe something in this area, okay, which is about what, we're saying about 440, okay, 440, 450, something like that. Okay, so are we overly concerned? Probably not. Do we want to be aware? Absolutely. But just know this hasn't been a hard and fast resistance for the last 5 years. And so maybe we'd be looking to go a little bit higher on it. Good question. Thank you for asking that, Mary. Let's see. Question here to Scott. I'll let Scott handle that. Will the dividend affect this trade? The dividends due to be paid on 6/15. Yeah, it probably will impact the trade to some degree. What usually happens? Usually we see this dividend getting paid. It looks like $2.32 out here on June 15th. So in a couple weeks. What usually happens that day? Usually the price of the stock, unless there's some other news going on that overcomes this, sometimes what'll happen, we'll see the price of the stock dip by whatever that dividend is. And I said, let's see, I thought it was like 232. I think that's my eyes are not as good as they used to be. I think that's saying 232. So usually the stock dips by whatever the amount of that dividend is. Typically it's a temporary. You could even go back in history and say, well, the last time they paid 221, so we're getting a couple cents more. Did it drop? Maybe a little bit. Doesn't seem to really impact it a ton. $2 on a $400 stock is really pretty small. All right, great questions, you guys. Next up, I want to jump to looking at what some of our trades have done. We've got at least one new trade on, but I've got more planned for us here today. And I'm happy to know that a lot of you are already thinking the way of just get a bunch out of the toothpaste. Don't plan on getting everything. I can see by your thoughts here, you're thinking that as well. Oh, looks like we have a survey out in the chat. Neither Scott nor I control when a survey comes in, but occasionally we'll throw a survey out. Those of you that have been here before know that we just like to see what your opinion is about this particular class on a scale of 1 to 10. Just plop the radio buttons, 2 seconds, you're done. There's a couple questions. If you feel like you want to answer more, feel free to. We love to hear your comments. And I also encourage you to, if you want to communicate something with me, a problem you're having, a question that is coming up that's not resolved, let me know what that is, because I love to incorporate those types of things into our sessions. Okay, so let me know there as well. Scott and I will remind you again before the session's over. All right. Let's take a look next at, let's follow up on one of our trades from last week, which was CrowdStrike. Anybody follow along with CrowdStrike? Let's maybe change this to a 3-month chart so we can kind of see the trend here a little bit more easily, what's going on. Last week, we got in our trade on the 28th of May. That's when we met last. We were seeing this nice little breakout on the flag, and we extended the flagpole out here as a potential place that the stock might go. One thing somebody noticed that, hey, earnings are coming up pretty quick, and so the decision was made, we'll be out before they announce the earnings. We'll take ourselves out of the trade. Well, it turns out we didn't have to really worry about it. The next morning, we were out of the trade. We had a nice little move. We got out on this day with a little yellow oval. I kind of like that yellow oval. It reminds me of gold. Think, okay, yeah, we took some profits on the trade this day. Let's see what the actual numbers turn out to be on CrowdStrike. We went into it as a debit spread of 445. Up here in our orders, we said, if we can get 722, we will be happy campers and get out. Okay. We ended up getting out even a little bit higher than that. And part of that was that it had a really big move that day. So instead of getting filled at 722, it filled us at 790. Now, sometimes that can happen in a live market. Sometimes paper money is a little bit nicer to us than, say, the live market is. But sometimes things are bouncing around a lot in the morning. If somebody has a market order sitting out there, they might pair your order together with the market order and take whatever the market price is at that time. Okay, so sometimes we do get a little bit of a nicer fill. Doesn't always happen that way. Number-wise, let's see what we did here. On this, quick math, 790 minus 445 gives us a profit of 435. Actually, I'll take the dot out there. 435 per contract. How many contracts did we do? We did 4 of them. So a 2-day trade, on that one, we had a profit there of 1740. Remember, we always talk about it before commissions, and you always want to calculate your commissions in there for the number of contracts that you do. So nice. It kind of looks like, oh, Bill, that was a nice way for that vertical to treat us. We appreciate that. Next up, we're going to go with a loser. Okay. Sometimes we have losers, one that doesn't fare as well as we wanted to. A couple of weeks ago, we got into Bloom Energy, BE. We got in on this day, and at the time we got in, it looked like it was breaking above resistance. Turns out it didn't stay there very long. Pulled back. Last week in our class, it wasn't at a real dangerous level. We said, let's let it play out. And it in turn came down and hit our stop. Okay, so we did lose on this one. We risked up to $2,000 per trade. We're nowhere close to that. We'll go through the math here. Let's see on this one. We need a little bit more time in here. Let's go back. Let's go back 16 days here. There we go. All right. So we got in at a 445 debit. We would have been happy to get out at 722, but that's not what happened. All right. Instead, we got stopped out here. Our stop was at 222, and we got filled at 265. So we did have a loss on this one. Let's grab our calculator again. Hope you're getting used to working these numbers, feeling comfortable going through the math here. On this one, 445 minus 265 gave us a $1.80 loss per contract. How many contracts did we have? We had 4. So that one came at a loss at 720. Okay, so is that anywhere near our max theoretical of 2,000? No. And when we try to, we try not to take max losses on trades, right? We try to say, yeah, if it's met a parameter that things are just not going that way, yeah, let's get out and move on. Okay, that's what happened with BE. Now let's take a look at now. Let's look at the chart here first on now. That was the second new trade we got into last week. And we were just seeing it coming out of it, maybe a nice little pullback here. The day before we got in, it was sitting down here at the 10, and then we got in as it was bouncing up off this 10. We got in this day. Next day, it had a huge move for us. So boom, we're out of it again really quickly. Okay. If we go through and look at the numbers on now, our debit was 90, I should say. We said, we'll be happy if we can get 169. We were not going for all the toothpaste. We were just going for a chunk, a bunch of it, right? We ended up getting filled a penny difference, so $1.70, which was nice. So on this, we had a profit of, let's go back to our calculator. Quick math here. We did 90 cents from $1.70 is $80 per contract. We had 23 contracts. So times 23, that's about $18.40. Okay, so between our two long verticals that were new. Both of those were successful. We're always happy to see that. We're in a bullish market, so we're happy to see that. But things are not always that way. Like on our BE trade, it just didn't materialize, even though it looked like it had a good setup, and that happens. That's just part of trading, right? And we try to minimize that loss, and then we move on. All right. There are a couple that we need to roll here. So let's get into come back here. Let's do Microsoft first here. Microsoft is both of these actually, they're on here, are diagonals. And they're ones that we've been working on over the week. So some of you I know are paper trading with me. And so you're going to have some, questions probably come up, which I love to hear. We have a longer dated call option for July on Microsoft. We're bullish on it, right? We've got 43 days out here. And the idea here is Microsoft has a lot of options that we can choose from, right? Because they have Monday, Wednesday, Friday expirations. In our class, what we've chosen to do is sell the Friday. And then each day or each time we have our class, if we haven't rolled it, we're typically going to roll it because it only has 1 day left. It's going to expire tomorrow. We brought in 590. It hasn't diminished a whole lot there, but we did get something out of it, right? 590, 410. So, or if we go buy it back right now, maybe about $4. Okay, so maybe we get $1.80, $1.90 out of it. For a week, that's not too bad. We've still got our longer dated option. What our hope is that as we sell and sell, that this net debit of 1735 on this expensive option, our net debit gets a little lower and a little lower and a little lower. That's what we're trying to do with it. We're being very active. So we're going to roll this to what? Let's go figure it out. These are the ones that expire next week. I told you wrong on this. I was thinking they had Monday, Wednesday, Friday expirations. I'm in the wrong stock. Okay, let's go to Microsoft. There we go. Okay, good. I'm not wrong. Sometimes I am wrong, right? So we could go out to Monday, Wednesday, or Friday, but we're going to choose Friday. And right now, our short leg, what's that strike price right now? That one is at 430. Okay. Which technically right now is a little bit in the money because Microsoft has gone above 430. And so, you can be as conservative or as aggressive as you might want to be, right? If you think the stock's popping up right now, then you might want to go, you could be maybe a little bit more aggressive. In this case, it's kind of pulling back a little bit. Yeah, it's up on the day. We're happy about that. But we might go a little bit further out of the money. We might sell something like, somebody aggressive might go a 40 or a high 30 delta. Somebody more conservative might go a 30 or a 20 something delta. And so this is why you practice it, see where your comfort range is. We're going to go with this one right now. We're going to go with the 440. Has a 34 delta, lots of open interest there, lots of contracts. Oh, that makes us happy. Nice 30-cent spread. Hopefully we'll get it maybe at a midpoint there. Okay, but we know we're trading with lots of contracts. Microsoft does a ton of trading every day. So let's do it. We're going to go to June 12th. We're going to go to 440. So we'll come in here on our short leg and we're going to say create a rolling order. And don't worry so much about what it is saying here. Sometimes it'll say calendar, sometimes it'll say diagonal. But what it does is it goes out and it grabs the next one in sequence. Well, we don't want June 8th. We want to go out to June 12th, right? Because that'll be, just check my calendar. I think that'll be next Friday. Yeah, that'll be next Friday. And then we said 440. It doesn't know what strike price we want to do. So we have to tell it we want to do 440. And so in the end, this is going to give us about a 77-cent credit, taking into consideration what we're selling the one for and what we're buying the other one back for and the credit that we're bringing in. Now, if you're like, oh, I kind of want a little bit more than 80 cents credit, then you might choose a more aggressive strike price, right? You might choose something with a little higher delta. You know, instead of going out to 440, you know, maybe you want 435, right? This is up to you to determine how aggressive or conservative you want to trade it. So we're going to go with that for today. Go ahead and we're going to hit confirm and send. We're going to send it to that bucket so it lines up there. We'll keep track of it. All right, we got filled on it. We need to roll something else. Last week, we put on a non-traditional diagonal. Remember we talked about this? There are things that are traditional and things that are not traditional, okay? We did it on Palo Alto Networks. And I've got to get my dots on there, but we just did this last week, which was the 28th. So it was right here looking like it's bouncing off that 10-day moving average. It's been in a nice uptrend. This one we said was non-traditional. Why was it non-traditional? It was because I said, I want you to be thinking of this trade as something where we're trying to just sell premium. We're trying to sell some nice juicy put premium, but we need a hedge leg, okay? So let's come over here to the monitor tab. Let's open up PanW. So yes, we're bullish on it, okay? We wanted to sell premium on it. We sold $10.10 worth of premium on that put. Sweet. What's it down to? 16 cents. Nice. Man, we got most of the toothpaste out of that one, didn't we? Not always planning to. And the idea here is that we're going to sell premium, sell premium, sell premium. We've got an August dated option, and we're using the long leg as a hedge, just so that it doesn't tie us up as much cash to do this kind of a trade, and so we're not in a naked put position, right? If we were in a naked put position, we're saying, okay, we're willing to accept ownership of this stock at that strike price, but that's not really what our intent is. Our intent is to try to sell as much premium as we can, bring down this net debit. So 2180 minus, let's call it 10 bucks for ease. Yeah, we've decreased the cost of this long put quite a bit, that hedge piece, okay? We're going to go sell some more. Now, it did go through earnings. It actually had some pretty decent earnings. Market's reacting a little bit, I'm going to say unenthusiastically. But it looked earlier today, looked like it might be bouncing off that 10. We'll have to see. It looks like that move has faded a little bit now. But we're going to go out to our option chain. We're going to go out to next Friday. We're going to go out and we're going to sell some more premium, okay? This one we have been a little bit more aggressive with. We didn't go out to the 30s on this one. On this one, I'm going to go maybe about a 40 delta, okay? Remember on the delta that it gives us an idea of if the stock moves $1, how much does the price in the option chain change, okay? And we're always working with a couple here. Many times, sometimes the deltas can offset it a little bit. But ideally, we're looking at this as selling another put. Oh, I've got to get on the right side, Connie. Get over here on the put side of things. And we want to sell, I said a 40-something. Let's maybe go with these that have about the same amount. If we add up the volume and open interest, these are about the same. Let's go with the 43 delta. Let's go with the 267.50. Okay. So again, we're going to go out and roll. And I'm going to write down 267.50 so I don't forget which strike price that is. We're going to roll. Now, some of you might not be comfortable with the rolling process. What you need to understand is that it's going to create a commission because all we're doing is closing out one trade, cost of commission. We're opening another trade, cost of commission. We just kind of are doing it in one motion, but if you don't feel comfortable doing it in one motion, just do it in two, right? Come in here, buy back the put. We'll know our commission's in there, right? Closing an order. And then we're going to be selling the 267.50 in place of what we had here, which was a 250 put, okay? If the stock had gone a little bit higher rather than pulling back, you know, we might be selling the 250 again. But in this case, we're going to adjust. We're going to adjust for what the stock has done. So here, let's go. We're going to create a rolling order. And it doesn't know necessarily which one we want to do. We're not interested in rolling our long leg. We are interested in rolling the short leg. So we're just going to pick that. It's going to go show buying back our 250 put. And then again, it doesn't know what we want. We do want June 12th. We want that date. We're going to change this to 267.50 right there. And a $7.03 credit. We can't feel too bad about that, right? And again, the idea here is our hedge leg is just acting as a hedge leg. We're kind of thinking in the mode of sell premium. And it's a little bit different way to do a diagonal. That's why I wanted you to know it's not traditionally done this way. And just kind of emphasize that. Now, let me see what kind of questions we have on this one before I send it off, because there could be some questions on this one. KL says, I've rolled either up and out or just out nighttime. So far, I'm up a bit. How's this working for anyone else that replaced the trade originally? Oh, you might have put that in, K Hill, when we were talking about Microsoft. Okay, so Trader Joe says, why are we buying a put on PanW? So that long put we're just using as a hedge leg. Non-traditional way to use diagonals. And I'm going to reiterate that every time we look at this trade from here until August, assuming we're still in it, that this is not a traditional diagonal. We're really selling puts and we're buying that long put as a hedge leg so we can sell put after put after put. That's our intent. Okay, so yeah, it is a different way of thinking about it. And that's why we're doing it. Normally, if we were going to trade something bullishly, we'd do like the Microsoft, right? Normally, we'd buy a longer dated call and then sell maybe an out of the money call against it. Now it would be traditional, and this one's non-traditional. Okay. I know some of you have actually heard of this and asked me about it. If you had a little bit different rules, but it was kind of the same idea here. So let's, we got 703 here. Let's put it in our bucket. Let's go ahead and roll it. And next week, we'll do the same thing. We'll see, hey, have we been able to have theta work for us to decay the value of that shorted dated short option and hopefully let us collect a lot of the premium from what we've just sold. Okay. All right. You were talking about Microsoft. So you've been in the Microsoft trade for a little bit of time here, Cahill. Yeah. Absolutely. I guess Southwest says, what's the risk with this new setup? Well, the risk with this new setup is kind of interesting, is that it could go flat on us, which wouldn't be entirely wrong because we just have time decay working for us. What we're going to find over time, and we did this with a non-traditional one that we were doing a few months ago, is the one thing that we found is that our long leg here will be decaying. Okay, so right now it has decayed, right? And the intent here is to say we don't care. We want it, it can decay, it can do whatever it wants. Now, if the stock actually really drops here, then this is going to be the leg that will be benefiting from it, but our intent is to consider it still a bullish trade, that we're just kind of selling puts, having that hedge leg. Okay, but yeah, there's absolutely risk that that it goes down instead of up. Then yeah, then we'd probably have to close out of the trade at some point. All right. For these strategies, what option level do you need? Oh, thank you for answering that, Scott. Scott said, level 2 or higher is very typical. Bogus says this works with leaps as the hedging leg. You could go out that far if you wanted to. Some of those leaps are really expensive. But if you wanted to experiment with that, Bogus, absolutely you could. All right. I'm going to put on an additional trade here today. Ooh, I'm going to have to choose here. Let me go back and check out a couple of charts. Now, earlier we had a now trade. We're out of the now trade. I'm going to look at this. I'm going to look at Wells Fargo, because both of those were given potential entry signals here. Maybe we'll use the Wells Fargo one here. With Wells, we see they've pulled back a little bit, but they've put in a pattern of higher highs and higher lows, right? Here it kind of bottomed out around 72, higher high, higher low, higher high, Didn't really pull back that much, and now another higher high, really breaking against above some resistance here today. It's hard to tell. It's early in the day. It's hard to tell if this is really going to turn out to be extra volume or not. If it is, then that would give it maybe a little bit more power, or maybe more consideration that a lot of the markets moved in on, or institutions and others are moving in when we see extra volume. A little early for us to tell if that's going to be the case or not. But let's go with our Wells Fargo here. Now, I had pulled up now, and I have to tell you, I don't mind trading the same stocks over and over and over again. Okay. Earlier, this was looking more like a Harami, but it's not looking quite as bearish now as Wells Fargo. So we're going to go with Wells Fargo. All right. And what are we going to do here? We're going to do a long vertical. Okay. We have stocks that are moving. We're going to expect they're going to continue to move. Don't know that they will, but that's our expectation. This is kind of nice because the 10 crossed the 30 moving average today. Some people like to see a shorter moving average crossing over a longer moving average. Just adds to the bullishness of the trade. But when we see something like that, but let's come out here to the trade tab. Let's put something together here on Wells. Wells, we're going to use the June 26s as well. So let's close the 12s. Let's come out here to the 26. We're going to do a long call vertical. Okay, very traditional. There's decent open interest here for the number of contracts that we would be doing. If we did not feel comfortable with the number of contracts, you might come out here to the July, and you can see thousands of contracts. All right, but this, trades a pretty decent volume. All right, stock right now is at 81. And so we would maybe do here, let's see, I was thinking to do the 81, 83. Let's see if those numbers still make sense. We may have to change that, but we're going to go too wide on it. You don't have to go too wide if you don't want. If you wanted to do it just a single wide, you could. All right. It's going to make it a little bit more efficient for us as far as commissions go. And we're going to risk a little bit more than $1 to make a little bit more than $1. Okay, so it's going to be a little less than 100%, probably 90 something percent. Okay, potential return. Again, we're not going to go for the 90%. We're going to go to the chunk of toothpaste. That's what we're going to be happy with. Okay. Let's see if we can risk $2,000 per trade. How many contracts can we do here? If we're going to risk $2,000, divide that, we're going to go by 103. We can do 19 contracts. If you don't feel comfortable doing 19 contracts here, some of them have a few more than others. You could adjust it if you wanted to. Then 83 here has several hundred. If you're not comfortable, you could choose different strike prices where maybe you were comfortable, right? You might choose 82, 83 maybe. Okay, but we're going to go ahead with our 19 contracts. And then when would we want to get out? We're going to do something different than 50% on this one. Okay, we're going to go 70% on this one. Okay, so if we have 0.97 as our max theoretical gain, if we think, oh, we'll be happy at 70%, we're going to add 67 to 10. It was 103. Let's put it back at 103. We're going to get about at $1.70. Okay, let's do a first trigger sequential, create our opposite order, plug in that value, which was, my short-term memory forgot exactly, 170. Okay, we're going to go 170. Would be happy to get out then, right? See if it'll let us out early. Make that good till canceled. Put it in our bucket. All right. Now, kind of just to summarize here real quick, we put on two long verticals, Wells Fargo and UNH. We rolled our two diagonals that we had in process. We rolled the options on the put diagonal, the call diagonal. And then we also saw that our two long verticals from last week, man, they hit their targets pretty quickly. We were out. Okay, that's kind of a summary of what we've done here today. Now, I hope you're following us on our Trader Talks channel on YouTube. If not, just go down and click on that little blue icon in the bottom right-hand corner of your screen. That'll allow you to see our content. Makes it so much easier to follow us and go to our playlists. Coming up next, we're going to see Brent Moore's going to lead us in a discussion investing in dividend stocks. And so we're going to take a little bit of a break. He will start at the top of the hour. So again, there's a survey out there. Would love to hear your feedback on the survey. If this was helpful to you today, hit the thumbs up button as well on your way out. That lets others know you found it valuable, that they might find it valuable as well. Appreciate your input here today, Scott. Thank you for your help in the chat. All right, you guys, we'll follow up on all these trades next week. We'll see you then. Bye-bye.